their clients in all sorts of markets, whether they are in the bull phase or the bear phase. And today, we are particularly delighted to welcome Mr. Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers. Manish has had a three and a half decade experience on Dalal Street. He's worked earlier with top PMS companies and is now building the same business at MK Investment Managers. He runs a corpus of 2,000 crore rupees. Namaste Manish ji, a very warm welcome. We are interviewing you after a long time, and the tailwinds in the market appear to be very strong. GST collections are improving, auto sales are at top. How do you see the markets at current levels?
I think 25,000 on the index is more or less a floor. If you were to take the next 6 to 9 months point of view, in the next 6 to 9 or 12 months, we should be closer to 30,000. That's what I believe, because things cannot get any worse from where we are. Things can only get better from where we are. On the one hand, you have very benign inflation, you have low interest rates, you have earnings trajectory start to look up from what the numbers were previously, 10% now giving way to 12, 13% sort of an earnings growth for the next 2 years. You have a GST cut, which is propelling consumption. You have an income tax cut, which has also propelled consumption. 6 lakh crores worth of spend during Diwali. You have a further 8-pay commission recommendation that will come to in the next 15 to 18 months. So all in all, I think things are pretty decent for India. And since India has underperformed emerging markets in the last 1 year to the extent of 25% when we compare ourselves with emerging markets, the discount or the premium, sorry, not the discount, the premium to emerging market has narrowed down from 75-80% to just about 50%. Has the things been so worse that we are underperforming emerging markets by 25%? I really think there is a disconnect. And so from that point of view, I think these are great levels to buy. I remain bullish on the market.
Wonderful. On this very strong and bullish note, ladies and gentlemen, let me also welcome my co-anchor, Abha Bakaya, into the conversation. Abha, the opening quote with Manish is a strong batting pitch for the Nifty. He's looking at 30,000 fairly shortly.
He's looking good, Manish, and it's always great to hear you sound so bullish and so confident of the market's trajectory from here. Clearly, the next question will be where you're seeing value in, arguably overpriced market. Which are the segments that you would weigh up more heavily?
So I think it's now a no-brainer that consumption is starting to look up. The proof of the pudding seems a 6 lakh crore worth of spend during Diwali. So obviously one thing is proved for sure is that in India, if you hit the affordability quotient, then you have a J curve when it comes to consumption. And that is what we have seen during Diwali. Maybe this is the inflection point when you start to see consumption pick up rapidly on the back of measures that have been taken by the government. So heavy lifting on the earnings for the next 9 months, 12 months is clearly consumption. I would lean more on the side of discretionary consumption, and particularly those areas of discretionary consumption which has something to do with affluence, because this is one segment of the market which neither gets very bogged down when we are in troubled times, and when the going is good, this seems to start build up even further. So from that point of view, anything to do with premium consumption, according to me, on the discretionary side, will do much better. Then we have the banking, because of very benign cost of capital, and the cycle seems to be turning up when it comes to the credit pickup in the system. An obvious beneficiary of that would be the banking system. I've been leaning more on the public sector banks where there is valuation comfort, and at the same time the earnings growth is also pretty decent. That is not to say that large private sector banks won't do well, they will also do well. On the other hand, you have insurance where GST has been cut. You have a lot of penetration that is still to be done in the insurance space, both the life insurance as well as the general insurance, health insurance. These are areas where there is ample valuation comfort. So again, this is one area. Pharma CDMO, again a very heavy lifting that needs to be done, and the ample opportunity of growth remains. We are looking at capital market, which is an evergreen story from the next medium term point of view. The financialization of savings looks pretty decent. Infrastructure, government spending would benefit. These are some of the areas where we are overweight on, and we'll be placing our bets majorly on these sectors.
Right. Manish, before we drill down into what MK likes and where the money is deployed, are you absolutely certain that this October consumption theme is not a flash in the pan, in the sense that you see continuous capital and consumer spend happening in the economy? Are you hopeful on that trajectory?
That is what the management seem to allude to. We have spoken to a large number of consumption-driven companies like the QSR space, and everybody, or the consumer durable space, or the automobile space. I mean, they all seem to be believing that the order backlog on the demand for some of these categories has just not ended with the Diwali season. It's still continuing. So this has got to do with the consumer sentiments that have turned for the better with the cut in GST rates and a pass through of these lower GST rates that have propelled consumption. And I think the build-up is only going to get better. That is what the sense is, what we get from the consumer-driven companies. At least this far, this earnings season, that is what the sense is.
Okay, so when we're talking about discretionary, let's dive a little deeper there, because of course, auto has seen this immense run up, and we're seeing a lot of action, a lot of launches, positive sales numbers. We've also seen some action in other durable makers on the back of the GST relief within the discretionary basket, or is it via some of the financial firms? What are you looking at, and what are your top picks?
So discretionary, I think autos remains at the forefront. You have durables which remain at the forefront. You have leisure and travel. The hotels and the airlines. These seem to be doing pretty well. Again, on the discretionary side, I think penetration stories on health insurance remains very good. You'll start to see pickup in health insurance premiums, etc. going forward. These are some apparel, fast fashion. And particularly when we talk about some of these categories, if you were to platformize these businesses, then I think the runaway for growth is even better. So, some of these platform tech-driven companies merit onto the consumer tech platform. I mean, they would tend to do very well is what we believe.
Okay. Manishi, now let's drill down into what MK has deployed in terms of 2,000 crore rupees. In terms of just broader deployment of such capital on behalf of clients, what is the presence of large caps, mid caps, and small caps as a percentage of 2,000 crore rupees?
I think by and large, MK deploys capital based on the growth strategy. We are growth investors and we like growth. Broadly, you can say that 40% is deployed in large caps, 40 to 45% is deployed in large caps, and 50 to 55% is deployed in mid and small caps. The idea out here is to create wealth for our clients and to buy companies younger in the cycle. That is not to say that the growth is coming for large cap companies. We'll shy away from that buying. But we are alluding to buying growth, whether it is large cap, mid cap, or small cap. Ideally, we would like to buy companies which can double their profits in 3 to 4 years. This growth should be coming through operating leverage as opposed to financial leverage. We don't really like too many highly indebted companies. The management should be good. We don't want to overpay. That is to say that the price comfort has to be there, and the terminal value, which is the longevity of growth, should be a good 5-10 years from the point of view when we are trying to look at these stocks. So the business environments are prone to disruption, particularly in these times. We want the continuity of the business model run by good management, and companies should deliver growth to the extent of at least 18 to 24% in their profit.
Okay, that sounds like a very very ambitious kind of outlook coming in. But Manish, you're smiling, so clearly you believe it's going to happen. And but can I debate that for you for a moment, because I think we are seeing some earnings action this time around, but I would say we're still a little far away from reaching that double-digit traction in a sustainable way, and with sort of a more breadth of the market. It's still very stock specific right now.
Yeah, the idea is to find those 25, 30 odd companies. There's nothing that in a portfolio would be looking at the entire gamut of 5,000 odd stocks. Having said that, I think even Nifty 50, if you were to take the next 2 years point of view, you should be clocking in 13% sort of a growth. So we would be clocking double digit growth for sure. And even in the mid and small cap space, let me tell you, if you were to crunch your numbers very well for the next 2 years, they should also be trajecting 15% sort of a growth. That is to say that, there's ample to pick and choose in the marketplace. And, you don't have to buy the entire index. You have to buy those 25, 30 odd nine. And there's ample number of stocks where you can have that 18, 20% sort of a growth. Only question is what is the valuation that you want to pay? And that is where the pick and choose will come into play, because the markets will factor in the growth, but they will also price in the valuation. The biggest challenge in the market today is not to find the growth point of view. The challenge is to find growth at a reasonable price. That is where your art part of the investing comes into the play.
That's a fair assumption to make. Of course, in this market where hunting for value is a difficult task, but 20, 30 companies, yes, you can easily, if you're a long-term investor, buy into them. Manishji, two broader threads in the market which have done phenomenally well is the PSU banking basket, driven by tailwinds of further mergers ahead, and of course the NBFC space, where a lot of foreign companies want to take up stake in Indian NBFCs like Shriram Finance, like Samman Capital, just to name a few. In terms of representation, how is MK structured in the PSU banking basket, and your view on NBFCs?
Yeah, we have some exposure to PSU banking names, niche plays. So to name a few stocks which are there in our portfolio, we have a Jammu and Kashmir Bank, which is playing the region of Jammu and Kashmir, where they have a large monopoly position in terms of deposit mobilization. The CASA ratio is very good. You're getting the bank at 12,000 odd crores. And, in the next 5 years, my sense is they'll have an annualized profit number of closer to around 5,000 crores annually. So from that point of view, the risk is to reward plus the deposit franchise of this bank. We like this bank quite a bit, in spite of the problems in the region currently. So we are actually getting a very good growth business at a very reasonable value. This is one name that we have. Then we are betting on Bank of Maharashtra. Again, out here, you'd see that the growth vis-a-vis the valuations are very, very conducive. You have an 18 to 20% ROE business, which is growing at 15% and less than 10 prices to earning multiples. Again, we find a lot of value. And I think if there were to be announcements regarding consolidation in the PSU banking space, it couldn't get even better than this. So these are the two names, apart from, let's say, a State Bank of India, which looks pretty decent. So it's a play on the corporate loan growth, plus the valuation, plus the very good deposit franchise that some of these banks have, that we are betting on this space. As far as the NBFC space is concerned, I think, if we were not to have any further rate cuts, then broadly you should be looking at an expansion of margins from where we are in some of these plays, and niche plays like, we are having a few of these names like Shriram Finance Limited as one of the plays in our portfolios where, the numbers just came in, the growth vis-a-vis the valuation appears very, very conducive. Apart from a Bajaj Finance, which is an evergreen play, for 3 decades, they have been growing at north of 20% with an impeccable asset quality and a very superior ROA and ROE. So these are some of the NBFC names that we like.
Okay. What about real estate, Manish? Coming back to demand and consumption and discretionary, what do you feel about the real estate plays?
See, my sense on the real estate space is that given the liquidity in the system and the high growth, and obviously discretionary consumption will tend to pick up, and the cycle of consumption, investment, and savings will tend to do well in micro markets. So Bombay, NCR, Hyderabad, Bangalore, these are some of the spaces where I think the demand and supply, you're still dealing with just about 18 months of inventory, which is normal. And I think there's ample growth in the system in some of these micro markets, and real estate as a play will have definite pick and choose on the consumption side, on the discretionary consumption side. And I think more luxury projects, the better the sale is going to be, the better the pre-sales are going to be. So betting on not the affordable housing segment, but more on the premium and the luxury segment in the real estate, we think that the demand is far outstripping the supply even now, even though there's a lot of overbunching of supply in MMR, etc., on account of redevelopment. But I think, we remain benign in terms of understanding that the absorption is also going to be pretty decent from the next 1 to 2 years point of view. So even this is a very decent play on the discretionary consumption side, the savings side, from the next 2 years point of view.
Right. And this question I'm going to ask on behalf of Abha, which is this mad rush in the IPO space, Manish bhai, valuations that defy logic, profit numbers that probably aren't very good to explain to. How do you see this IPO market? How does MK plan and play with this, valuations of triple-digit PE and badly done RHPCs? How are you sort of grappling with this issue?
Shailendra, let me just first put across the fact that some of these businesses which are coming out with an IPO are fantastic businesses. And why I say this is because, first of all, if you are platformize a particular business, you are playing with a lot of operating leverage, provided you get your unit economics right. So some of these businesses that are coming out with an IPO are pretty decent. Secondly, intermediation as a business. So intermediation as a business is a very good business. So we have seen intermediation as a business in the form of, let's say, Policy Bazaar, that's an intermediate between a consumer and an insurance company, or a Zomato or a Blinkit, which is an intermediate between the consumer and the restaurant or the kirana shop. Similarly, some of these companies are turning out to be intermediaries. You have, let's say, a Grow, which is an online broking platform, or let's say we have a Pine Labs, which is basically an intermediary between the shop and the customer in terms of payment processing. Some of these businesses are fantastic businesses because these are intermediation businesses. You don't require too much of capital, and there is very high operating leverage. So these are good businesses. Only point is, what is the valuation that you want to pay for some of these businesses? That is the only hitch. So I think the question is not about the quality of these businesses. The question is definitely that what is the price that you want to pay for some of these businesses? You can't look out into infinity to price these businesses. There is where the maximum problem is going to be lying. Because if you pay at the time of buying, you'll have to spend a lot of time in terms of your holding period before you start to see return on your capital. So I think there is where the problem is. That is where the maximum problem is, and there is where you'll have to have a pick and choose. But platform businesses are going to do very well going into the future, provided you buy them at a particular price. Just to give you a case in point, when Zomato came out with an IPO, it was a consumer tech business. They came out with an IPO, if I'm not mistaken, at 72 rupees per share, but on the listing days, the stock price went to north of 100 rupees. And thereafter, it crashed to 40 rupees. And from there, the build-up on this company started to happen. So similarly, some of these high-priced companies first will see a correction in the market, and maybe at that point in time, it's a great time to buy some of these businesses for the long term.
So unlike some of the other players, I think you've said in the past, Manish, that pockets like, for instance, defense or industrials may look expensive, but you did mention power, utilities, and perhaps looking within that space for value. Is that still your view?
The PSC index has done very well over the last 1 year, in spite of all the the naysayers saying that there is no value in the public sector enterprises. So PSC index is at an all-time high. So public sector units, I would continue to believe that they exhibit superior growth and available at a fraction of the valuation at which the private sector is available. And these are large monopolistic businesses, which defy logic when it comes to investing. If these are not investing thesis, then what is investing? Growth at reasonable price, they are epitomes of growth at reasonable price. And the workings of some of these businesses are now catching up with the workings of private sector enterprises. You have seen how the public sector marketing companies, the oil marketing companies have got related. We have seen some of these defense companies in 2020 were available at 3-4p. Today you want to pay a top dollar for a 40-50p for some of these companies. So it's only a matter of time when the public will start to realize what the value in some of these businesses are. My sense is if you are buying into monopolistic public sector enterprises, you can't go too wrong if you buy at some of the valuations at which some of these companies are available.
I think this is a masterclass on how to trade momentum on one side, which Manish Bhai is thinking in terms of Nifty, and of course to buy where value is. Another value field or value minefield, depending upon how you look at it, Manish Bhai, is the software space. Many of our erstwhile momentum picks 15-20 years ago are in single digit PE. I refer to the erstwhile software leaders. Now, are you as a value conscious fund manager looking at maybe Infosys, TCS in the large cap space? What is your research team thinking about the entire software space because of problems which have come in because of artificial intelligence?
Yeah, artificial intelligence also, the jury is still out. I mean, you have a lot of investments going into the AI infrastructure builder space. You have the data centers and the gen sets and the, the plumbing and the air conditioning portion of the businesses, which are doing very well. But what is the use cases in some of these AI names still yet to be figured out. So traditional IT businesses will continue to stay here, albeit the double-digit growth rates is somewhat far away because legacy traditional IT services businesses is somewhat at a very slow pace. On the other hand, the GCCs are tending to do quite well. The India's market share in the overall IT spend is likely to maintain, and at the same time, valuations have halved over the last 3 years. So from that point of view, I think, when we look at, let's say, even the overseas listed companies like Cognizant, etc., the growth numbers don't seem to be that bad compared to the valuations at which some of these companies are available. And mind you, even the traditional IT vendors like the Infosys, TCS, etc., are incorporating AI in their business models. We have an HCL Tech which reports its AI numbers separately this quarter. $100 million is something which they reported. So I think, AI is an integral part of the IT businesses. Traditional infrastructure, IT businesses, etc., will give way. But given the valuation and the growth, I think there is value in the IT space. And one should definitely be looking at some of these plays. Only thing out here is that large IT vendors, the third-party IT vendors, where you have a very large force, reskilling some of these large employee base is going to be difficult. Mid-cap IT vendors, where there are lower number of employees, reskilling some of these in favor of AI, etc., is going to be easier. So I think it is all about pick and choose, but I am not negative on IT space per se, just because AI has come into the picture. AI has a long runway to grow, but today the use cases on AI are far and few in between.
All right, Manish, we'll leave it there. Thanks so much for joining us. Always a pleasure chatting with you, and great to hear how bullish you are on the markets, as well as some of the key multi-bagger ideas that you have, and even your view on the IPOs. Thanks so much for being with us today.
Thank you so much. Thank you.